Ever felt a little knot of worry in your stomach when thinking about where your money is sitting? You're not alone. Whether it's the few spare dollars you're investing through an app or the cash tucked away in a savings account, the question of safety is always there. And when it comes to platforms like Acorns, which blend investing and banking-like features, understanding how your funds are protected becomes even more crucial. So, what happens if the unexpected occurs? What safeguards are in place to ensure your hard-earned money doesn't just vanish? That's precisely what we're diving into today. We're going to unravel the mysteries of FDIC and SIPC insurance, specifically in the context of Acorns, so you can invest and save with greater confidence and peace of mind. Let's start with FDIC insurance. You've probably heard of it, especially if you have a bank account in the United States. FDIC stands for the Federal Deposit Insurance Corporation. It's an independent agency of the U.S. government that plays a vital role in maintaining stability and public confidence in the nation's financial system. Think of the FDIC as a safety net for your deposits held at member banks. If an FDIC-insured bank fails, the FDIC steps in to protect your money, up to a certain limit per depositor, per insured bank, for each account ownership category. Currently, that standard insurance amount is $250,000 per depositor, per insured bank, for each account ownership category. Now, how does this relate to Acorns? Acorns offers a checking account feature called Acorns Checking. Funds held in your Acorns checking account are typically held at Lincoln Savings Bank, which is an FDIC-insured institution. This means that the money you keep in your Acorns checking account is eligible for FDIC insurance, up to that $250,000 limit. It's important to understand the per depositor, per insured bank, for each account ownership category part. If you have multiple accounts at the same FDIC-insured bank but under different ownership categories, e.g., a personal account and a joint account with your spouse, each category could be insured separately, potentially increasing your total coverage at that single bank. So, if Lincoln Savings Bank, where Acorns checking funds are held, were to fail, which is a rare occurrence, but it's what FDIC insurance is for, the FDIC would step in to ensure you get your insured deposits back, up to that $250,000 limit. This provides a significant layer of security for the cash you're managing through your Acorns checking account. However, it's crucial to remember that FDIC insurance specifically covers deposits held in checking accounts, savings accounts, and other types of deposit accounts at insured banks. It does not cover investments, such as stocks, bonds, mutual funds, or ETFs, even if those investments are offered through a bank. This distinction is key when we start talking about the investment side of Acorns. This brings us to our next important piece of the puzzle, SIPC insurance. SIPC stands for the Securities Investor Protection Corporation. Unlike the FDIC, which protects cash deposits in banks, the SIPC is a nonprofit, federally mandated corporation that protects investors if a brokerage firm fails and is unable to return their cash and securities. Think of SIPC as the safety net for your investment accounts held at member brokerage firms. Most reputable brokerage firms in the United States, including the brokerage firm that Acorns uses to offer its investment accounts, are members of SIPC. If a SIPC member brokerage firm goes bankrupt or experiences financial difficulties and client assets are missing due to fraud or other reasons, though not due to market losses, SIPC steps in to restore those missing assets to the customer, up to $500,000, including a $250,000 limit for cash claims. Now, let's connect this to your Acorns Invest account. When you invest through Acorns, your money is used to purchase shares of exchange-traded funds, ETFs. These ETFs are held in a brokerage account. Since Acorns Securities, LLC, the entity through which you invest, is a member of SIPC, the securities in your Acorns Invest account are protected by SIPC insurance. This means that if Acorns Securities were to fail and your securities were missing due to the firm's financial difficulties, SIPC would work to return your covered investments to you, up to that $500,000 limit. This provides a crucial layer of protection for your investments held through the platform. However, just like with FDIC insurance, it's vital to understand the limitations of SIPC protection. SIPC does not protect you against market losses. If the value of your investments goes down because of market fluctuations, that is not covered by SIPC insurance. SIPC's role is to protect your assets in the event of the brokerage firm's failure, not the failure of the investments themselves. Furthermore, SIPC coverage applies per separate customer. Generally, each account held in a different capacity, e.g., individual account, joint account, at the same brokerage firm is considered a separate customer and is eligible for up to $500,000 in protection. So, to recap the Acorns landscape. Acorns checking. Funds held in your Acorns checking account are typically held at Lincoln Savings Bank, an FDIC-insured institution. This means your cash deposits are insured by the FDIC up to $250,000 per depositor, per insured bank, for each account ownership category. Acorns Invest. Investments made through your Acorns Invest account are held at Acorns Securities, LLC, a SIPC member. This means the securities in your investment account are protected by SIPC up to $500,000, including a $250,000 limit for cash claims, in the event of Acorns Securities failure. It's also worth briefly touching on Acorns Later, retirement accounts, and Acorns Early, investment accounts for kids. The funds in these accounts are also held at Acorns Securities, LLC, and therefore are also protected by SIPC insurance under the same terms and limits as your Acorns Invest account. Now, you might be wondering, why do we need both FDIC and SIPC? They serve distinct but equally important roles in safeguarding your financial assets. FDIC insurance is specifically designed to protect the money you entrust to banks in the form of deposits. It helps maintain public confidence in the banking system by assuring depositors that their funds are safe, even if a bank fails. This encourages people to keep their money in banks, which is essential for the flow of credit and the overall health of the economy. SIPC insurance, on the other hand, is tailored to the investment world. It protects investors if their brokerage firm becomes insolvent and cannot return their securities. This helps to build trust in the securities markets and encourages individuals to invest, which is crucial for long-term financial goals like retirement. Think of it this way: FDIC protects your cash parked in a bank, while SIPC protects your investments held at a brokerage firm. Since Acorns offers both a checking account, holding cash, and investment accounts, holding securities, understanding both types of insurance is vital for Acorns users. With that said, thanks for watching, and until next time.